For today's lesson, we're going to look at the external sources of finance. It is going to be a longer lesson. However, now coming into the school holidays, you'll have a little bit more time to go through a lot of these terms that you will need to know, because in this section is where the examiners will ask you to offer some suggestions to businesses on how to borrow money, what kind of borrowing is going to suit them. But you might also get questions in terms of what is a short-term borrowing method. So if you put something that's long-term, you're obviously not going to get those marks for those questions. We're then going to look at equity. And when we look at debt and equity, equity is, I guess, people externally buying an ownership in your company. So that's why it's considered equity finance. So with our external sources of funds, that refers to the money that is borrowed or obtained from outside of the business. And there's two elements there. You've got your debt finance and then you've got your equity finance. So this diagram here shows you that on one side we've obviously got our debt, and on the other side we've got our equity. Under that debt financing, we have short-term and then we also have long-term. And similarly with equity finance, we've got ordinary shares and then we've got private equity. And we'll look at each one of those separately and break down each one of these particular elements and then potentially look at some of the advantages and disadvantages of using that type of finance, because that's where you're going to be able to offer that well-rounded suggestion or recommendation to the business, maybe in a business report or also in short answer questions. Now, just one of these points here on this slide, I'll just try and get it up. It says here it involves a contractual relationship, so a loan contract such as length of time, interest rates, fees and default penalties. And that's something that we're going to discuss when we're looking at all the different types of short-term and long-term borrowing, because there are different, obviously, lengths of time. Interest rates will vary depending, I guess, on how desperate you are, and then the fees, and then again you weigh that up. Obviously, failure to pay any debt back is going to result in some kind of legal proceeding, so the business might go into liquidation, and again we're seeing that a lot with businesses in this day and age. Now you can have funds provided by government and non-government sources. So a lot of governments will provide grants for businesses. They can be secured or unsecured, which means that are they secured against something, a building, a car, some kind of money, or are they just going to give you the money and it's not going to have a surety against anything? So when we look at our first one here, we've got short-term borrowing, and the three things that are under that as per your syllabus are an overdraft, commercial bills, and then factoring. These are given by financial institutions. So here we've got obviously our banks. Borrowed amount needs to be repaid within 12 months. So because it's short term, you have to remember that it's to repaid within 12 months and is used for immediate expenses. So this is your everyday, day-to-day spending within the business. Now, if we look at the first one, which is overdrafts, withdrawing a larger sum of money than what is in the bank account up to an agreed amount, limit and time of repayment. So what's happening here, a bank will allow you to write checks for a certain amount, depending on, I guess, what you have negotiated with them, but also what your income is. And you can write checks. So let's say you're a builder and you're writing a check for, $500,000 worth of bricks, but you don't actually have that in the bank. You know that you're going to get paid that money pretty quickly. So the bank might give you, up to 180 days to pay, that overdraft back. So, you might be a business that only has $1,000 overdraft. So it just depends, I guess, on what kind of business or what industry you're in. Interest rates and costs on overdrafts are lower than a standard business loan, and this is used for a temporary shortage of funds. So you can't just use it for a long-term period. Now the next one here that we're looking at are commercial bills. Now with commercial bills, short-term loans for over 100,000, the lending period is 30 to 180 days. Obviously there's interest that you need to repay, but this time it's secured against the business's assets. So you're putting something down as a surety. Can we just disregard this slide, please? Now, in regards to the third type of short-term borrowing, here we're looking at factoring. Now, factoring basically is selling your debts to somebody else, and then it's their job to chase the money. So you'll receive 90% of the amount within 48 hours from the factoring company, and then that factoring company is then going to chase those people that owed you money to give them back that money. So I guess the trade-off here is that they make a little bit of a percentage of that debt. So they will make, say, 10% of that debt. It's one way of ensuring that you get your money straight away, and then you don't have to chase those companies for that money. So if you were asked to define factoring, a good definition, I guess you're looking at here, factoring enables the business to raise funds immediately by selling its accounts receivable to a factor company at a discount. The factoring company pays a lower price than the value, usually 80 to 90%. Why would we do it? We would do it because we want to make sure that we can get our money back into the business as quickly as possible, and that's obviously going to help your short-term day-to-day liquidity in the business. So this is just an example, I guess, of what the factoring would look like. So let's go through this. You sell $10,000 worth of goods to your customer who is given 30 days to make full payment. Your business, though, suddenly needs but can't get a proper bank loan, and you know your customer will eventually pay the $10,000 back, but you've got to wait 30 days for full repayment, which is obviously not ideal in this situation. You go to a factoring company or a third party that provides this type of finance, and you begin this transaction. So the factoring business, Factor Me Inc. says, okay, I'll buy your accounts receivable. The Factor Inc. gives you 85% advance rate with a discount of 3%. This means that you're immediately going to get $8,500 from Factor Me. Factor Me will start to get the repayments from your customer over the next 30 days. Once your original customer repays Factor Inc. back, then they will give you the remaining $1,200, subtracting the 3% discount fee. So for $10,000 worth of goods that you sold to your original customer, you're actually going to make $9,700 in immediate cash, which works out really well, because it doesn't matter that you're losing that 3%, because that 3% could turn out to be a lot bigger if you spend time chasing them, you've got workers or part of your staff ringing them, and you know, hassling them for that money. So with long-term borrowing, we've got 4 types of long-term borrowing. We've got mortgage, debentures, unsecured notes, and leasing. This money is usually borrowed for longer than 12 months, and you would use it for larger purchases, so land, buildings, or equipment. So a mortgage, this is taken out to purchase business property. It could be an office or a factory. It must be repaid before the property is resold, and you must repay it with interest. So these are sort of your up to 30-year loans. And yeah, you can't sell a property with a loan left on that property. Now with debentures, on the previous slide you would have seen a few dot points, but when we're looking at debentures, they are also called corporate bonds. So you might actually see that depending on what you're reading. This kind of debt is only for companies, not individuals. So a corporate bond is a way for a company to raise money from investors to finance its business activities. In return, the company will issue a bond, and they will promise to pay you interest, pay you back the money you've invested by a certain date. Now, obviously there's risks involved, so you may not get the money back if the business can't pay you back. but that's unfortunately something that happens with a lot of this debt financing. How is it different? A debenture is just a type of corporate bond. So like I said, it is for a fixed rate investment, sorry, and must be paid back accordingly. So with an unsecured note, this is borrowing money from public, so the investors, with a promise to pay it back with interest. Now, because this is not secured against a company's assets, the interest rate that the person that's borrowing this money is charged is going to be significantly higher because of the high risk. So this is where people might decide, yeah, it's worth it. I'm going to earn a lot more interest in the short term, and the person borrowing is quite desperate. Okay, so with leasing, this is one that we see a lot of. Now, we at school, we would lease our photocopiers, we would lease cars. So what you're doing here is you're leasing some kind of equipment. It's like you're renting it, basically. And when sort of something happens to that particular piece of equipment, the company will come out and fix that. The reason people will lease is it will keep some money in their reserve. So they're not going to spend $10,000 buying a brand new photocopier, but they're going to rent it for a certain amount each month. So some of the advantages of leasing, it assists business with cash flow. Repayments are spread out over many years, and we're actually going to see that when we start looking at our financial statements. The more that you can spread your payments out, the better it's going to be for your day-to-day cash flow. If you take out a big chunk of money today, that could potentially affect you next week. Monitor cash flow as repayments are fixed. So I know every month that $49 is going to come out of my account. I can account for that. Costs may be lower than establishing the other sources of finance. And in this instance, you know, you're not going to have establishment fees and everything else that comes with the other forms of borrowing. Now this is looking at our next lot. So we looked at our debt financing. Now we're looking at equity financing. And this is selling the business's shares to potential investors, and we'll go through what they include. Now, when we're looking at shares, there's 4 different ways, I guess, that you can offer shares. The first one is new issue, issuing and selling shares for the first time on the stock exchange, and a prospectus is required. So a prospectus will tell your investors what are they going to get for this money that they're investing. Where is this money going to go, and how is it going to benefit them? The next one is a rights issue, so giving existing shareholders the privilege to buy new shares in the company. So you send a letter to your existing shareholders saying, we're looking to raise some more revenue. Are you interested in buying shares again? And the last 2, we're looking at placements, or a proportion of shares that are given at a discounted value to specific shareholders and investors. I think this would be to specific investors, because you don't want to give too many shares to one person where they could essentially maybe have greater control within the business. So you're determining who can you give shares to and who maybe you don't want to in terms of ownership. And the last one is a share purchase plan. So you're allowing existing shareholders to buy more shares without brokerage fees and or at a discounted value. So you don't need a prospectus here, because you're just asking, it's almost like a little bit of a top up. Now, private equity would be for a private company, and in this instance, you're selling business shares to private investors. So you're asking, or you're offering them to certain people. So we know that from a private company, what we did in year 11, you can be invited to buy shares within that business. They're not freely available on the stock market. So an example of private equity, think of Shark Tank. So what you do on Shark Tank, the owners of these private companies go onto this show, they tell the sharks how wonderful their product is, and then from there the sharks will then determine, am I going to invest in this business and get an awesome return, or am I going to give it a miss? The next couple of slides will look at the advantages and disadvantages of debt and equity financing. So here you've got advantages and disadvantages of debt financing. So if we look at some of the advantages, funds are readily available and can be acquired at short notice. Yeah. Increased funds generally lead to increased earnings and profits. Absolutely. So you want to, I guess you want to spend money to make money. Interest payments are tax deductible, flexible payment periods are available, and existing ownership of business is maintained. Obviously, with those advantages come disadvantages. You have to pay back interest rates, bank charges, fees, government charges, all of that on top of the money that you've actually borrowed. Security is required by the business. Regular repayments must be made with interest. So you can't just say, oh, I'm not paying this month because I don't feel like it. Lenders have first claim on any money if the business ends in bankruptcy. So if you do become bankrupt, then the bank is who's going to get the money back before, let's say, your suppliers and your and you. Expensive to service the debt because of the interest rate. Now, with our advantages and disadvantages of equity finance, the advantages are that it does not have to be repaid unless the owner shareholder leaves the business. Cheaper than other sources of finance, and there's no interest payments. Retain control over how the finance is used. Use the owner's own resources without using other external sources of finance, so less debt. That's the money that you put into the business, so the owner's equity. Less risk for the business and the owner. The disadvantages are that your shareholders are going to expect a return on investment. They're going to want to see that they're getting actually some money back from this investment. Long and expensive process to obtain funds. Extensive documentation, so a prospectus, you've got to put a prospectus together, which can be time consuming, expensive, and also you have to make sure that you have put all the necessary information in it. The ownership is diluted because the more shareholders you have, the more owners you have, and then the less control of the current owners. So what you need to also make sure that you know is looking at which type of finance are you going to use that's going to be the most beneficial for the business, and is going to be, I guess, sometimes the cheapest form. You know, is it something they need straight away? Is it something they can hold off for a while? So this term here, matching the term and sources of finance to business purpose, is something you need to be aware of while you are writing your notes. So let's look at a question here. This is the 2013 HSC short answer question. MKPTY Ltd is a successful chain of frozen yogurt stores with low gearing, which means they don't have a lot of debt. The owners are planning to take over a smaller chain which has poor human resource management. Question is, discuss one source of finance to fund the takeover, and we'll look at the answer on the next slide. So what a sample answer could look like: as the business has low gearing, the business should use long-term debt finance. Debt finance provides a relatively quick injection of funds, facilitating the takeover, allowing for business growth. Debt finance may increase risk due to increased repayments and changes. However, the increased return generated through the business expansion should cover an increase in debt repayment. So here you can see how they've spoken about the low gearing at the beginning. They've given some information in terms of why they should undertake debt financing, what the risks are, but then at the end, what's the return going to be? What's that link? What's the bonus at the end? You could also, we would have taken answers for retained profits, but how do we know? We don't know how much they actually have. We could have looked at a mortgage, so be specific in terms of what kind of debt finance you're going to undertake.